Is SCHD still a balanced dividend ETF? Or did it just turn into an oil income fund in disguise? That might sound dramatic, but the numbers say something big changed. After the March 2025 update, energy stocks jumped to almost 21% of the portfolio. Before that, they were closer to 12. Now Chevron and ConocoPhillips alone make up more than 8%. That's a huge tilt toward one sector. Most investors haven't noticed because SCHD's payout looks stable. But stability can hide concentration. If oil prices swing, SCHD will swing too. And that's the conversation most people are avoiding. In this video, I'll walk you through the evidence, step by step. I'm not here to scare you. I'm here to show you the math. You can decide what it really means for your portfolio. Chapter 1. The Hidden Risk Hypothesis. Here is the core idea I want you to test with me. When SCHD increases its energy exposure to about 21% after the March 2025 reconstitution, it quietly changed how the fund behaves. It became more sensitive to oil prices and to the earnings cycles of big energy companies. That shift is not just about price movement. It affects how the fund grows its dividend too. Because SCHD's dividend growth partly depends on capital gains from rebalancing. Lower price momentum can slow that process. So the hidden risk is not only sector concentration, it is that SCHD's dividend engine now relies more heavily on a volatile part of the market. Let me show you the numbers behind that. Chapter 2. Evidence A. The reconstitution. How much energy exposure changed and top energy holdings. Let's start with what actually changed. During the March 2025 reconstitution, SCHD's energy sector weighting increased sharply. It went from around 12% to about 21%. That is a jump of roughly 9 percentage points in one update. To put that into perspective, 1/5 of the entire portfolio is now tied to the performance of energy companies. The two biggest names are Chevron and ConocoPhillips. Together, they make up about 8.3% of the fund. That is almost 1 in every $12 invested in SCHD, going into just those two energy giants. The total fund size is large too, roughly $68 to $71 billion in assets. So we're talking about billions of dollars redirected into energy stocks in a single reconstitution. This happened while the fund maintained its traditional focus on strong cash flows and dividend history. But now those dividend payers include far more companies whose profits depend directly on oil and gas prices. In other words, SCHD's steady reputation now comes with a growing exposure to one of the most cyclical sectors in the market. Most investors see the same ticker, the same yield, the same logo on their app. But underneath, the engine is different. And this change alone sets up the next part of the story. Because what SCHD does with those holdings affects how the dividends behave. Chapter 3. Evidence B. The rebalancing engine. How SCHD's dividend growth is partly mechanical and depends on capital gains. Now, let's look at how SCHD actually grows its dividend. It is not only from companies raising their payouts, there's also a mechanical part built into how the fund rebalances each year. During the 2025 reconstitution, about 19.2% of the portfolio turned over. 17 stocks were removed and 20 were added. This constant reshuffling helps SCHD capture higher dividend yields from new positions while trimming older ones that have appreciated. But here's the key point. That process depends on the fund having capital gains to reinvest. If the overall price performance is weak, the engine slows down. We can already see hints of that. In 2025, SCHD's capital appreciation was only around 1.5 to 2.8% year to date. At the same time, dividends showed large swings. In the first quarter, the payout rose about 22% year over year. But in the second quarter, it fell by roughly 5%. That kind of volatility is not from company cuts. It's from timing and rebalancing effects. So when energy stocks make up a bigger share of the fund, their price behavior feeds directly into how much capital gain the fund can realize and reinvest. If oil prices drop, that flow slows. If energy rallies, it speeds up. This connection makes SCHD's dividend growth less predictable than most investors think. It's still strong, but it now runs a more cyclical fuel source. Chapter 4. Evidence C. Price Sensitivity. How SCHD performance will track petroleum and energy earnings. Now that SCHD has about 21% of its portfolio in energy, its behavior naturally moves closer to that sector. When oil prices rise, those energy names push the fund upward. When oil prices fall, they drag it down. That link is already visible in the short-term data. Over a recent 3-month period, SCHD gained around 9%, with most of that move coming during a stretch when crude prices also climbed. In a single month, the fund was up about 2.6%. Again, that was during a period when energy earnings were strong. It is not a coincidence. Chevron and ConocoPhillips together, making up more than 8% of the fund, respond directly to oil and gas price changes. If both stocks dropped 10%, that alone could shave almost 1% off SCHD's total value. And that's before accounting for indirect effects on other holdings that supply or service the energy industry. The files also note that global tensions, such as conflicts in the Middle East, have supported energy prices this year. That geopolitical boost helped SCHD's short-term results. But it also highlights the risk. Those are not stable or predictable factors. If oil stabilizes or corrects, the same exposure that lifted returns could pull them back down. So even though SCHD still looks diversified on paper, its short-term performance now depends more heavily on a single global commodity. That doesn't make the fund bad or broken. It just means its sensitivity profile has changed. SCHD has started to behave less like a broad dividend fund and more like a partial energy proxy. That's fine if you understand it, but dangerous if you don't notice it. Chapter 5. Practical Implications and Risk Quantification for Investors. Let's translate all of this into something you can measure. If SCHD's energy weighting is about 21% and you hold SCHD as 50% of your portfolio, your real exposure to energy is around 10.5%. That's already higher than the energy weighting in the total US market index. So it's important to know where your risks overlap. Here are 3 simple ways to manage it. First, mix SCHD with another dividend ETF that focuses outside the United States or outside the energy sector. That balances the sources of income. Second, size your SCHD position based on your comfort with energy cycles. You can do a quick check by multiplying your SCHD weight by 0.21. That number tells you your hidden energy exposure. Third, rebalance once or twice a year. If energy prices rise too fast, trim a little. If they fall sharply, review the holding before adding more. None of these steps are advice. They are just ways to keep the exposure visible instead of hidden. Understanding where your dividend yield really comes from is the first step to managing risk. Chapter 6. Compliance and Safe Disclaimer segment. Before we go further, a quick but important note. Everything in this video is for education only. It's not financial advice. Past performance doesn't guarantee future results. All the numbers shown come directly from SCHD's March 2025 reconstitution data and related public filings. Always check the latest data before making any decision. If you want personal advice, speak with a qualified financial professional. This video is meant to inform, not to predict or persuade. So, let's bring this together. SCHD's March 2025 reconstitution pushed its energy exposure to around 21%. That one move made the fund more connected to oil prices and energy company earnings than ever before. Its dividend growth engine still works, but it now depends more on market cycles and capital gains from those energy names. The hidden risk is not a collapse, it is concentration, and concentration changes behavior. SCHD can still be a great income ETF, but it's no longer the same balanced dividend play it used to be. Now you know the data, not the headlines. So I want to hear from you. Do you think SCHD's new energy tilt is a smart long-term shift or a short-term trap waiting to play out? Share your thoughts below. I read every comment, and your insight often shapes the next video.